Good afternoon, everybody, and welcome to this very special broadcast of our 2024 Economic and Market Outlook. I'm Damon King, a certified financial planner professional and wealth manager with ChappelWood Financial Services. We are the sponsor for today's special broadcast. I also want to introduce some of the other members of our team. We've got, as you see on the screen here, we'll introduce our special guest in just a moment, but you also see Meg Wiest. Meg, waves, everybody. There you go. There's Meg. Meg is our client onboarding specialist and handles a lot of our internal needs for clients, taking phone calls, making sure money gets moved in the right places. We're also joined by Lisa Ward, CFP. She is our certified financial planner in our Arlington, Texas office and is doing some great work down there. She's our lead advisor in the entire state of Texas. So no pressure, Lisa. You have to cover the entire state of Texas, which I understand is just a little bit bigger than Oklahoma. And then she's not on the screen over here, but Lynn McGuire is also in our office. She's a member of our team. And whenever you call ChappelWood Financial, she's the first voice that you hear when the phone gets answered. And of course, our fearless leader, the financial diva, Victoria Woods. She's not on at the moment, but she is our president, CEO, and our founder. And she founded ChappelWood Financial Services a little more than 30 years ago. So I want to share with you a little bit about who we are here at ChappelWood Financial, because many of you are not clients, you're not members of the ChappelWood family. So you won't begrudge me this short little commercial, right, about ChappelWood Financial. We are an independent registered investment advisory firm. Our home base is in Edmond, Oklahoma. Of course, now we do have the office in Arlington, Texas. And we are a comprehensive wealth management firm, which means that we don't just manage investments for our clients. We handle a variety of needs that our clients have, whether it has to do with asset preservation and protection, cash flow management, tax management, helping our clients with Social Security, Medicare questions, long-term care. Just got an email from a client. We're going to be analyzing her long-term care insurance policy to see whether or not it's still a good deal. We help our clients with pretty much anything that they have going on in their financial life. And as we like to say, if there's a question that you have to answer that is going to impact you financially, we want to know about it. We want to help you with that. We are also advisors to millionaires. So we do specialize in working with families that are high net worth families, retirees that are millionaires, multimillionaires. As I mentioned, we do have a presence in Oklahoma City and Arlington, Texas, but we really have clients coast to coast. We've got clients in Palm Springs, California. We've got a client in Panama City Beach, Florida. So and everything in between. So we've got clients all over the place. And here at our firm, we really have a focus on education, which is represented by this webinar today. We really believe that when you are empowered and you know why things are happening in the market and the economy, that helps you to make better decisions. It's not enough to us that you know what might be being done in your portfolio. We want you to know the basic reasons why. And we like to explain those in normal language that normal humans speak, and not all that advisor vomit that professionals like us sometimes use to make themselves look really smart and important. So we really do believe in education very much. There are different ways that you can connect with us here at ChappelWood. Of course, all of our clients know this, but here are some ways if you're looking like, how do I benefit from some of that education? Here are a few ways. We do have a radio show, if you're in the Oklahoma City area locally, that airs on Saturdays at 1 p.m. or Sundays at 6 a.m. on News Radio 1000 KTOK. That's one of the AM talk stations here in the Oklahoma City area. Victoria and I co-host that show. I write and produce and co-host that show every week. But you can also stream us on the iHeart Radio app. If you want to stream us there, you certainly can. Open up your iHeart app on your Android or Apple device, and you can stream us there. You can also subscribe to our podcast. We take the show and turn that into a podcast. It's on Google Podcasts, Apple Podcasts, SoundCloud, Spotify, and a few other places that I don't even know what they are, but we're everywhere. We're omnipresent. You can also subscribe to our Wednesday lunchtime drive-through. This is a weekly webinar, a live webinar that I host almost every Wednesday, probably at least 45 Wednesdays out of 52 in the year that we host this live webinar, and we talk about a variety of topics related to your money. And it's not always just the market and the economy. Sometimes it's, I've done one on investing in artwork. I've done Bitcoin. I've done all kinds of different topics. Cutting the cable cord, how I did that. So it's a variety of things. You can also text the word gold to 405-348-0909. When you do that, you will get an automated message back to you where you can download a complimentary copy of our Gold Bucket Optimizer. The Gold Bucket Optimizer is something we use with every single one of our clients. And if you're a client of ChappelWood, you know what your gold buckets are, right? You've seen them. And you can also get a copy of that. You can print that out, fill it out. And when you fill out your gold buckets, it's going to do three things for you. Number one, it helps you to see where your money is. Number two, it helps you to see how much of your money is in the market versus in cash versus protected. And then it helps you to make informed decisions about how to rebalance that wealth. One of the key things about retirement, it's balance. Balance of your assets. Where is my money? And you're trying to balance money that is still growing and at risk in the market versus money that is liquid and perhaps safer. And that's what it's all about. Retirement's about cash flow management, more so than it is asset management. And that's what we help our clients do. And you can also subscribe to our YouTube channel, Financial Diva. That's the channel. You can go there and subscribe, and we're constantly uploading content, short little videos, informational videos that you can use to help make better decisions for you and your family. So those are some of the ways to connect with ChappelWood. And of course, you can get your phone out right now, open up the camera, and scan that QR code right there. And what's going to come up is a page where you can watch a short video about the ChappelWood Millionaire Experience. What is it like being a client here at ChappelWood Financial, and some of the partners that we bring to the table for the benefit of all our wonderful clients. And speaking of wonderful partners, it is my great honor today to introduce not just a partner, but a friend. Karen Ibe, she's here in the Oklahoma City area, but she travels all over the country. She is a client advisor and vice president with JP Morgan Asset Management. JP Morgan is one of our top investment strategists for high net worth families. And I tell Karen all the time, one of the coolest things they put out it may be every day, I don't know. It's called the Guide to the Markets, and I know you're going to be sharing some of that information today. But JP Morgan is really where we get a lot of our research. We gather research and information from multiple investment strategists. JP Morgan is absolutely one of our go-tos because they are constantly keeping information updated on the economy, the market, what's the Fed doing. Karen, I'm sure you have a cot at the Federal Reserve. You know exactly what's happening all the time. Probably the only thing that Karen can't do is make sure that Jamie Dimon doesn't open his mouth all the time, So, now that was me saying that. Karen didn't say that. So Jamie, if you're watching, it's not Karen. That was me. Okay. And you can't do anything to me. So there you go. All right. So let us welcome our special guest, Karen. So Karen, I'm going to stop sharing my screen here, and I'm going to let you come on the mic here and share your screen. And I know that our clients and our special guests today are dying to know all of the big questions in the economy and the market. So I'm going to let you take it away. Thank you so much for being here, and welcome.
Oh, well, thank you, Damon. And thank you, Meg and Lisa, for letting me join you this afternoon. And in case Jamie Dimon dialed in, I love you, Jamie Dimon, and I love JP Morgan. So we'll just go with that. But in all seriousness, thank you for taking time out of your afternoon to spend a little time here with us talking about the markets. I always love talking about the markets, but I particularly love talking about the markets when we reach all-time highs. So just about 45 minutes ago, we are back at all-time highs on the U.S. stock market, just shy of that 5,000 kind of psychological barrier on the S&P 500. So we're going to dive into all things market related. Damon is going to pepper questions throughout our time together. So if you have a question that you'd like to ask, feel free to add it to that Q&A. And I'm going to go ahead and share my screen. Because if you're like me, when we start talking about financial topics, it's just helpful to have a visual to go along with everything that we're talking about. So like Damon mentioned, one of the key reasons why advisors work with us is our access to research. So yes, we do update our research on a daily basis. Everything that you're going to be looking at today is as of yesterday's market close. And if you're interested in diving into the weeds on some of this, feel free to reach out to Damon. He's got a copy of this and is happy to share that with you all as well. So anytime that I start talking about the markets, I generally will start with this slide from JP Morgan. So first of all, when people are talking about the markets, what are they talking about? Well, there's a number of different key measures of what the market actually means, but most people, when they say the markets, they're referencing the US stock market. And specifically, we're talking about the S&P 500 today. So 500 largest companies here in the United States. And on this chart, what you're looking at is the return of the S&P, the price index, going all the way back to 1996. Now, nobody cares what happened in 1996. All attention is all the way to the right-hand side. And the topic of interest is really what's happened to the US stock market over the last couple of years. So as a reminder, the US stock market peaked out on January 3rd of 2022. We had a fairly dramatic drawdown to the tune of about 25%. That is officially called a bear market when you've breached that 20% drawdown. And then the market low so far was October 12th of 2022. And since then, the US stock market specifically has been on a tear all the way up, almost close to 40% off those October 12th lows. Now, I'm glad we're having this call today versus at the end of the third quarter, because it would have been a very difficult conversation and a much different conversation than the one that we're going to have today, because last year in 2023, we did have a couple of pullbacks in the stock market, and I'll show you more on that here in just a moment. But we actually had two 10% pullbacks, and one of those occurred in the third quarter. And then October 31st, we had some comments that came out of the Federal Reserve the first week of November that basically indicated that we are going to see a rate cutting environment this year. And again, we'll talk more about that when we talk about bonds here in just a moment. But that really led to a very strong rally in the fourth quarter. So I chat with a lot of investors across my particular part of the world, and I face a number of different sentiments about this. Some of you might be super excited about where we are today. Things are finally feeling better. It's nice to see the momentum of that price movement to the upside. Some of you might be sitting there thinking, well, now we're at all-time market highs, so that means that we're probably going to see one of these pullbacks here. And some of you may just not be sure what you think of, because even though we're talking about all-time market highs on the stock market, many people are not invested in just the US stock market, because that is one part of the overall markets that you can invest in. So you may be feeling like, I'm not back to all-time market highs, therefore, what does that mean for me? Well, let's dive into it. Now, this is the last 25 years of investing in the S&P 500, but I encourage you to really expand your vision to a much longer term approach. Now, this is that exact same chart, but it's not the last 25 years. This is the last 120 years. And you can see that the pattern looks very different. On the previous slide, we had lots of ups followed by downs, lots of downs followed by ups. This one, the pattern looks very different. The market moves sideways and higher. The market moves sideways and higher. And everything that I just showed you on the last 25 years, that's all encompassed over here all the way to the right-hand side. One of the things that we feel extremely confident about is that the markets always figure out a way to move higher and to the right. And the reason for that is because companies figure out how to make money no matter what's going on. We've seen that in more recent history, everything from the global pandemic to artificial intelligence that really captured the spotlight last year. But it happens all the time, and it happens through different recessions. It happens through different presidential administrations. Companies how to figure out how to make money. And that leads us to probably the most into the weeds nerdy slide that I'm going to show you. If you like this stuff, you're going to really want to dial in on this slide. If you're not, I'll give you the high level answer of what this all means here in a moment. But the number one factor that drives stock market performance higher and to the right over longer periods of time is earnings. Companies figuring out how to make money, how to produce goods and services that people want to buy. We measure that through earnings. And one of the key measurements that we're always looking at when it comes to the stock market is what is the anticipated level of earnings growth? That's the chart on the left-hand side. I had a chart previous that I liked a little bit better because it was just more easy to see that we are on pace for record earnings in the US stock market this year. Not only did we achieve record earnings last year, which nobody was talking about really, we are on pace to do record earnings this year. And guess what? We are on pace for record earnings next year. So I don't have a crystal ball, and we can revisit this in December and see how my predictions are accurate. But JP Morgan is expecting to have a really good year in the stock market. For us, that means we think you'll probably see higher single digits. If everything that we see right now continues to hold through to the end of the year, we think that the earnings growth is going to drive solid stock market returns. But that is not going to be a straight path. Nothing that I've shown you so far is a straight path. In terms of straight lines, this might be the only chart that I'm going to show you anything in terms of a straight line. But we are anticipating volatility. And volatility just means it's normal. It happens every single year. But again, I'm a visual person, so I like to see exactly what this means. The way you read this chart, anything above that horizontal line was a positive year-end number for the US stock market. Anything below it was a negative number. And then the red dot below each bar signifies the biggest pullback that we saw that year. So peak to trough in any given year, what's the biggest pullback that we saw? Now the punchline is right under the bold at the top, which is the average of all these red dots is about 14% every single year. That means on average, the stock market falls at some point during the year about 14%. But despite that, the market is positive 33 of the last 44 years that are shown on this chart. That's about 75% of the time. That's really good odds that the market is generally going to be a positive result for you. Now, all the way to the right-hand side, the market's up about 4% as of yesterday's market close. But we've actually already seen some volatility this year to the tune of about 2%. Last year, I mentioned those 10% pullbacks we saw. This is listing, the largest pullback that we saw, but we actually saw it twice. We saw it in the early summertime and then in that third quarter that I've already mentioned, but yet the market ended up positive 24%. More often than not, the stock market's positive, but every single year the stock market goes on sale. And that means that we can benefit when it does go on sale because we know that the long-term trajectory is always higher and to the right. The market has never failed to recover, and we don't think this time that it's going to be any different. Okay, so I spent a lot of time on bonds already. That's the star of the show. That's what gets all the headlines. That's what people feel excited about in their portfolio. Let's talk about bonds. Maybe I need a button that's like, wah, wah. If we could work on that, Damon, that might be helpful. Bonds. Bonds are where you lend your money to a company or a government and they pay you back your money plus interest. That's the way a bond works. Now, bonds, they're kind of the boring part of the portfolio, meaning they don't have the exciting ups as the stock market, but they also don't generally tend to have the exciting downs of the stock market. So this chart that I'm showing you right now, this should look oddly familiar to the one that I just showed you about the US stock market. You read it the exact same way. Anything above that horizontal line was a positive year-end number for bonds. Anything below it was a negative year-end number. But guess what? There's volatility in the bond market as well. And that's represented by the red dot below each of those bars. Now, I can show you the same statement about this slide that I said on the previous one, which is the average of all these red dots. It's actually better than stocks. It's only down about 3.5%. But despite that, bonds have been positive 43 of the last 48 years. That's 90% of the time. Bonds are positive, but you might be saying, hey, lady from JP Morgan, I follow bonds and I haven't had a very good experience in the bond market in the last couple of years. And you're exactly right. So 2022, we saw negative returns on bonds. And then here's this whammy, 2023, Actually, that was 21 that we saw the down 2%, and then 2022, that was the whopper for bonds. That is a function of how quickly interest rates rose during the course of 2022. The fastest rise in interest rates that we've ever seen. And guess what? Bonds work in the inverse of interest rates. So when interest rates go up, bond prices go down, but the same is true of the reverse. When rates are going down, bond prices rise. And so last year was actually a pretty good year in the bond market. But again, going back to my earlier comments, if you're saying, hey, my accounts haven't recovered, the main reason why is probably there was at least a portion of your portfolio in bonds. Now, the great news is that there's still opportunity in bonds right now. So even though we're sitting at all-time stock market highs, we still have room to recover on bonds. And that could represent a really good opportunity. And your professional money managers are taking that into account as they're thinking about how to allocate additional dollars. So let's see here. Let's just move forward to, this is a good chart that talks about how everything kind of works together. So this is called the asset class returns chart. It is not a periodic table of elements. I was helping my sophomore in high school study for his chemistry test, and my eyes were rolling back in my head when I started to talk about chemical reactions. But no, this might be equally as challenging. But what this is this is all the different things that you can invest in. So we talked about stocks, we talked about bonds. There's really 3 other asset classes that you can invest in. You can invest in commodities, which here in Oklahoma, our favorite commodity is oil and gas, but we also have other types of commodities like agricultural products like corn and soybeans or cattle. Gold and silver would fit into that commodities bucket. We also have real estate. So your own home could be a real estate investment, but you can also have real estate investment through commercial properties. And then there's cash. So there's really 5 types of investing that you can do. But like Damon mentioned early on, we try to make things overly complicated to make ourselves sound smart. So what we do is we break down those 5 classes into 11 different sub-asset classes of what you can invest in. And that's what you're looking at on this page. Now, what we do is we color code each of these asset classes because we're trying to look for patterns and seeing which tend to be good performers, which tend to be more challenging performers. And you can see that there's really no rhyme or reason as to what is the best performer in any given year. So 2022 energy was your best performer. Last year, S&P 500 was actually your best performer. So it really kind of shifts from year to year. So one of the things that we do is when we're talking about balance that Damon mentioned, how important that is, we look at that through what we call asset allocation. That's just simply the concept of not putting all your eggs in one basket. Now, it's the light gray bar going through the middle of this page, and we draw a nice black line to highlight it for you. But you can see that asset allocation is never the winner in any given year, but it's also never the loser in any given year. And all the way to the left-hand side, it shows you that asset allocation over the last 15 years on this chart is actually giving you a really strong result of over 8% annualized. Now, I have a lot of folks are saying, that's great, a diversified portfolio at 8% sounds fantastic, but guess what? I can get 5% out of cash, or I can get 5% out of a CD. So why would I consider ever thinking about anything beyond cash or CDs? And one of the reasons I like using this chart is because it shows you that cash over the last 15 years, that's the dark purple box, has only been the best place to be one time. And guess what? It wasn't last year, and it wasn't 2022. It was actually 2018. That's the market where the markets kind of fell apart at the end of the year and ruined every advisor's holiday vacation. But that was the only time that cash has been the best place to be over the last 15 years. More often than not, if we're looking for a pattern, you're going to find it with cash, and it's at the bottom of this list. Even last year, cash at 5% was your second worst asset class to be invested in. And the other thing I like to show on this chart is how quickly sentiment around cash can change. So 2022, cash was only getting you 1.5%. That was not going to do anything to try to combat inflation numbers at almost 9% at one point. But here, cash at 5% feels a little bit better, but not when you consider all the other things that you can invest in. Ultimately, don't misunderstand me. I'm not beating up on cash. Everybody needs a certain level of cash, and that's very specific to your personal situation. What helps you feel comfortable that you're going to meet those short-term needs. But anything above short-term needs, the opportunity is really outside of cash and mainly through that diversified portfolio that we highlight on this page. Another way to take a look at this is just what happens to other investments after CD rates have peaked. And JP Morgan's outlook is that if rates haven't peaked, they're certainly very close. But we do believe that CD rates have peaked and that you will see interest rates fall this year. More likely, you'll probably see it happen sometime in May or June. March is pretty much off the table at this point for the Federal Reserve, which is our central bank here in the United States. They're most likely not going to cut in March. But what happens is pretty much everything does awesome outside of CDs once those CD rates have peaked. So that you as a CD investor, as a cash investor, because that's one of the 5 asset classes that certainly can earn a place in the portfolio. But the reality is you have significant reinvestment risk if you lock up money at those CD rates right now. And this just shows you in the last 6 rate hiking cycles that we've gone through, what's the forward 12-month return on a number of different asset classes. So core bonds is represented by the dark blue, equities are represented by the light green, and then that 60-40 portfolio is represented, that diversified portfolio asset allocation that we just talked about, that's represented by this bright blue box. And again, the story is the same. Everything does well outside of cash once you've reached that rate hiking cycle. Okay, so I've talked about long-term returns. I've talked about asset allocation and diversification. The antidote to volatility, to the ups and downs to the market, is really taking that long-term perspective. This chart just shows you that over the course of any one year, there is not a financial advisor on this planet who can promise you positive returns when you invest. Stocks can be volatile, bonds can be volatile, as evidenced by 2022. And even a diversified asset allocation portfolio, it can be highly volatile over the course of any one year. But if your time horizon is at least 5 years, there's never been a rolling 5-year period where you ever lost money through a diversified portfolio. And if your time horizon's even longer, up to 20 years, the worst you ever did in a 20-year rolling period was a positive 5%, but the best you ever did was an annualized 15%. That represents significant opportunity to achieve your goals by making your money work really, really hard for you. Now, I have one client, it's my dad, and he's also my worst client. I know it's going to be a bad day in the stock market when he calls me and he's like telling me, something he's already read. But his biggest objection when I show him all of these slides and talk to him about JP Morgan's outlook is, that's great, but I'm running out of 5-year rolling periods. I don't disagree with them. So what we do for my dad is we think about how can we leverage some of that future return now. And there are strategies that you can do that with. There's a number of strategies available at ChappelWood that allow you to focus on things like monthly income or using alternatives in your asset allocation. A lot of those things can really play a beneficial factor in making sure that you don't have to wait as long as 5 years for the market to recover. Okay, so I may regret this, but I'm going to leave you with one final slide on the presidential election, because that is certainly the hot topic of the day. So the reality is we do experience more volatility in an election year, but ultimately, usually election years end up really good. And the reason for that is because one of the things that the market hates most is uncertainty. And when you get into a presidential election year, that is one of the predominant factors that you see is a high level of uncertainty. So that can lead to periods of stocks being more volatile, even bonds being more volatile, because of what we talked about in terms of when is the Federal Reserve actually going to change interest rates. But at the end of the day, JP Morgan does not have an expectation that we will see a recession this year. And so the market should end up very strong. The chart on the right-hand side just shows you, going back to 1937, stock market returns by year in a presidential cycle. And you can see when I talk about, bonds up high single digits, like 9%, that's actually your average going back all the way to 1937. So because of that combination, along with the really strong earnings outlook and not anticipating seeing a recession this year, that's why we're pretty optimistic about the future of the markets. So I probably talked about presidential elections without really talking about presidential elections, which is kind of the best I could hope for. So Damon, I'll pause there. Those are my prepared comments, but see if there's anything that you'd like to clarify or any questions that you might have.
Yeah, thanks, Karen. Ladies and gentlemen, you can submit questions at any time. You can use either the Q&A button down below or the chat. Either one of those will work. I'll see it pop up, and I'll prioritize questions for Karen today. And I assume that you probably have a lot of questions. What does JP Morgan think? Karen, and I'll just to kind of get things started. Well, first of all, I'll piggyback off of the election thing. A lot of people, I come on here on my Wednesday webinar. A lot of the people who are my regulars, they get tired of me saying it, but presidential elections, who's in control, which party's in control, doesn't really matter. It really doesn't matter. Now, it is true that there are certain things that Republicans favor that tend to have positive impacts on the market. Republicans tend to be pro-business. They tend to be pro-energy. And so certain industries, they tend to be low taxes, low governments, low taxes, that sort of thing. And so that tends to help the stock market. But on the flip side, Democrats tend to be more government spending. Well, who are they spending that money with? Industries, the industries you invest in. So there's money to be made by the stock market. I like what you said, Karen. The stock market always finds a way to earn money. And it does that consistently, regardless of which party is in control. So the result of the election may matter to you personally, but in terms of making decisions with your 401k or your IRAs or any of your investments, you shouldn't allow that to dictate your investment decisions, because ultimately it doesn't really matter. It really doesn't matter. Any questions from anybody for Karen today, whether it's about the economy, the market, interest rates, likelihood of a recession? Karen, I have been saying for many, many months, probably almost a year, that the likelihood of a recession was very strong. And through much of 2023, the data that we were receiving seemed to indicate that. Now, I was, as recently as October, I was believing that and telling many clients that the odds of a recession were probably 70%. Unless we get a change, something had to change from where we were going. Well, we got that change. And one of the shoes I was waiting to drop was the Fed indicating that interest rates are no longer going up. That happened in what, November or December? And of course, I wish they had shut up at that point and said nothing about rate decreases going into 2024, because then that got everybody all excited. I agree. I don't think that's going to happen. You mentioned that JP Morgan's position right now is that we're not going to have a recession. What would you say? What are some of the reasons that lead JP Morgan to believe that?
Yeah. So last year, if we were here at this time last year, I would have agreed with you about a 70% chance that we would see an economic recession in 2023, probably in the third quarter. And guess what? It didn't materialize. And so now here we are saying no recession in 2024. That must mean that she's wrong and we're going to see a recession. No, at the end of the day, the reason why we don't anticipate a recession this year is a couple of factors. So one, we do think that we'll see an economic slowdown. So, certainly not GDP growth of north of the 3 to 4% that we saw last year, but nothing, completely alarming. We're expecting about 2.5% GDP growth this year, which is actually right in line with where it's been historically for a number of decades in our economy. And so one of the main reasons is that right now we have a really strong labor market. And as long as people have jobs, that means they go out and spend. And as long as people spend, they tend to have jobs because it creates jobs in other places. So it's a little bit of which comes first, the chicken or the egg, which comes first, the spender or the person with the job. It's kind of all hand in hand. So right now, we're continuing to see really strong job market. We're certainly seeing the idea that over the last couple of years, you could call a bit of a mini recession that we've seen in a couple of different sectors. So you could argue that 2022 brought us a tech recession, and you could argue that we've seen a real estate recession in 2023 and into 2024 as interest rates have moved higher. We might continue to see, periods of weakness in particular sectors. We don't have any right now that are currently on our radar. But again, the likelihood that you see broad weakness across all sectors of the market at the same time, it's just really, really hard to do that when you have a labor market as strong as ours is right now.
Yeah, I agree. I still think that while the risk of recession has fallen, and I certainly agree with that, and I've been sharing that with clients. We're conducting quarterly strategy meetings with many clients this month, and those that I've already seen have heard me say this. Those that I will see soon, you'll hear me say this. I'm much more optimistic today than I was back in October. However, a lot of this optimism, it continues to be driven by strong consumer spending. People keep spending money. However, whereas they were spending from their excess cash for a lot of last year, now a lot of that spending is on credit cards. We've got extremely high credit card debt in this country right now. And all it's going to take is for a rash of layoffs to begin, that sort of thing. How long can the consumer continue to spend money they don't have? How long? I don't know that that's sustainable. And if we see any weakening in consumer spending, a recession is less likely. It doesn't mean it won't happen. But even if it does, I think it'll be relatively shallow, relatively weak. The market might give back a little bit, but the market's almost always on its way back up coming out of a recession. So that's a good thing. Karen, can you speak to, and again, ladies and gentlemen, if you've got a question, please go ahead and enter it in right now. I will prioritize your question over my question.
I would like to hear about interest rates. I'm cutting you off, Damon.
Go for it, Lisa. Go for it.
How does that affect the market overall? Does it affect one industry more than another? And then how many rate cuts do we think we'll have? And if we do have them, when? Because I've heard 7, I've heard 3. It's happening in March. It's not happening in March. So what's JP Morgan's take on all of the interest rate cuts?
Yes, great question, Lisa. So the outlook from JP Morgan, and let me just kind of back up just a moment and give a little bit of foundation around interest rates and how they work and how they operate. So the Federal Reserve is our central bank here in the United States, and their job is to look at a couple of key indicators and make sure that the economy is moving forward. So 2 of their primary indicators, we've talked about unemployment a little bit, and unemployment is one and inflation is the other. So they've got what we call a dual mandate. They're looking at those 2 things. I'm a keep it simple kind of gal, so here's how I think about it. I think about it like our economy is a bicycle, and the front wheel is inflation and the back wheel is unemployment. If things slow down too much, it's easy to fall over. If things get going too fast, it's easy to crash. So that's why the Federal Reserve is so keenly aware of making sure that they're making good statements that are not overly optimistic, but also not overly pessimistic. So their job is to make sure we're moving at the right speed. And one of the ways they do that is through increasing interest rates if they want to slow down the economy, or decreasing interest rates if they want to speed up the economy. So the Federal Reserve, they meet very regularly. Our friend Jerome Powell is the chairman of the Federal Reserve right now. And man, what an awful job he must have, right? Every single word that he has is sliced and diced by economists and news anchors. Just that man, the amount of anxiety and stress he must have on a daily basis is probably off the charts. But what he told us when they met in January, at the end of January, is that we are looking at 3, well, the Fed has said they are going to cut rates 3 times, meaning 1/4 of 1%. The other way we say that is 25 basis points. So 3 25 basis point cuts. They basically took the first cut of being in March off the table in this most recent meeting. And we are looking at them starting to cut rates in May or June, with the idea that the 3 rate cuts will be done before the election. One of the key things that the Fed is trying to do is be considered nonpartisan and trying not to be considered influencing the election or the economy in favor of one particular candidate. That often gets jumbled up in the rhetoric of politics, but that's their goal, is to be nonpartisan. Nonpartisan's a better word there. Here's the thing, though. We look at how the market perceives the data that the Federal Reserve tells us, and the market actually believes, and by market, I'm saying the bond market believes, that the Federal Reserve is actually going to cut rates 5 times this year. So there's a bit of a discrepancy between what the bond market believes is going to happen and what the Fed has said is going to happen. That's not that unusual, but what it does lead to, which is a bit of uncertainty, therefore more volatility in the bond market. So while we had a great year for 2023, up 6%, the bond market this year has actually given back some of them, and it hasn't been a super exciting first 6 weeks of the year. But ultimately, JP Morgan thinks your bonds are going to end up in a strong place, not as strong as equities, but in a strong place. Let's call it 6% for the year. Because the benefit right now is that you're not starting at interest rates of 0. You're starting of interest rates north of 4%. And that actually is a very healthy bond starting point for them moving around the margins in terms of interest rates. Anything I didn't cover on that, Lisa? Any other parts that I missed?
What industries might be most impacted by rate cuts?
Yes. So rate cuts, what benefits the most is actually some of your more aggressive, high octane type stocks. Because what happens is, we talked about her earnings drive everything. Well, a lot of those earnings are not just in 2024 or just in 2025. The portfolio managers at JP Morgan are looking at earnings even as far as 6 years out. And when you have to discount those earnings to present day, you have to use an interest rate multiplier. So that might be a little bit too much, but the point is that when interest rates are going down or at lower levels or more stable, that benefits some of your higher octane type stock investments. The other area that it benefits is your financial markets. So banks make money based on something called net interest margin, which is paying out customers on short-term deposits and making money on long-term loans. They can actually make more money in a higher interest rate environment. So it could be everything from a high dividend paying bank stock to a high flying tech company. Actually, all of them can benefit in an interest rate environment that is not necessarily high, but stable. It's not about high or low, it's about stable. For banks, it's about being high. They like to see as much interest as can be charged on both loans and paying out as little as possible to depositors.
You know, another aspect of portfolio management that we take a look at is managing you brought it up earlier, managing growth versus income. You know, and there's essentially 3 things that we share with our clients that they can do with their money. They can optimize it for growth, they can optimize it for income, they can optimize it for preservation, protection. And most people want to do all 3 at the same time to varying degrees. But one of those is almost always going to be the lead dog, right? And, you know, in 2022, when the market was careening down a hill, where was most of the damage being done? It was being done to growth assets. So to respond to some of that, for many of our clients, we de-risked. We didn't do this across the board because everybody's different and we customize those things. But de-risking doesn't mean always going to cash. Sometimes it means leaving a growth asset in favor of an income producing asset. And dividend stocks, as a subset of stocks in 2022, where the market was down 20%, dividend stocks were down half as much, you know. But then whenever the rebound comes, dividend stocks are often not as rewarded, you know, because everybody's getting in there. But what I think is interesting, and I'm curious, Karen, if you agree, there's an opportunity here. Right now, people love bonds because and cash because they're getting paid basically to sit on their cash. So why invest in a dividend stock paying you 3 or 4% and possibly the risk of decline of the value when you can sit in cash and get 5%? But later on, if the Fed really does lower rates, probably a decent opportunity to leave cash and now jump into dividend stocks, which will be seen as a bond proxy or a cash proxy that's paying a higher yield, higher income when cash accounts begin to lower their rates. Would you agree with that?
Yeah, and I think there's even an added benefit. So last year, while the market was up 24% plus some for dividends, that actually was very concentrated into just a handful of names. And so there's actually 493 other names out there that still have opportunities to recover. And a lot of those live where you're talking about in that dividend income space. And so there's a tremendous recovery opportunity from some of the stuff that just hasn't had the catalyst for it so far. So yeah, absolutely. I think you can get a little bit of all three when you think about what you're trying to do. The capital preservation part just probably has to be managed in a different way. But yeah, you can get income and growth when you think long term about some of these stock positions that have yet to rally.
Yeah, absolutely. You mentioned 493 stocks. So everybody's probably heard of the Magnificent Seven, the seven big tech stocks that basically drove almost 100% of all the return in the S&P 500 last year. And if you didn't have exposure to those seven stocks in some degree, you really didn't share in any of the growth. Or if you had a lot of other stocks that were not those items, those companies, and we're talking about Apple, Amazon, Microsoft, Nvidia, Tesla, Google, which is Alphabet, and Meta, which is Facebook. So those seven were the big winners. And the other 493 were kind of losers, you know. Are we beginning to see a shift away from those seven stocks having such an outgrown influence on the market so that now more of the stocks will share in some of that? Is that something that looks like it could be a possibility this year so that this rally is spread more evenly?
Yeah, that's the expectation. So when I talk about 12% earnings growth, you can get a solid 6% of that just from the seven doing what they do, operating, nothing super innovative. You can get a large part of your earnings growth just from those seven. But you only need the other 493 to give you 4 to 6% on the other side. And so the way I think about it is there's a lot of high expectation on those seven stocks right now. And in the market, it's much easier to disappoint when the expectations are high, whereas it's much easier to surprise when the expectations are low. Right now, the expectations are pretty low on the other 493, although, the fourth quarter rally kind of brought some optimism to them. But that's what we're looking for. We're looking for earnings surprises on those 493. And that's our job at JP Morgan, is to figure out which of those companies are going to be the best at doing that. And that's how we allocate our shareholders' money. And so the folks at JP Morgan are obsessed about finding out which of those companies are going to have the highest level of earnings growth consistently over time, so that it's just not a one-trick pony for 1 year when everything's awesome.
Yeah. Again, ladies and gentlemen, if you've got a question for Karen or for Lisa or for me, anything, ask any question. You can enter it into the Q&A or chat down below. You guys are a quiet group today. Maybe you're ruminating, you're thinking about what should I ask. There are no dumb questions. Ask anything you want about anything that you want. Lisa, did you have any other questions? Or Meg, did you have any questions that you wanted to share or ask Karen today? You're muted, Meg.
Who do you think's going to win the Super Bowl?
Oh,
Niners.
that's the real question, right? So I live in a 49ers family, I guess you could say. They're in the Super Bowl, right? That's about the extent that I know of Super Bowl. We're hosting a Super Bowl party, so I'm more concerned about what I'm serving than who's actually going to win. And I think the winner for me right now is white chicken chili. I just feel like that might have a huge fan base come Sunday. It's supposed to be kind of cold here in Oklahoma on Sunday.
Yeah, that sounds
Nice.
good. I like white chicken chili. Yeah.
There you go. Although Fritos, like, can't find Fritos to save your life right now.
That's right. Go with the scoops, the Tostito scoops. Those are really good. Those are good replacements.
Much
Absolutely.
more substantial.
That's right.
Maybe a gas station, you can get some free.
I'll buy all the little packets and put them together.
Just don't go to the gas station and get sushi. I've tried gas station sushi before. It's not a good thing.
That is a bold choice, Damon.
Yeah. I think I outkicked my risk tolerance on that one. So, any final? We've got just a few minutes here before we adjourn at 4:30 Central Time. Any other words of wisdom? Anything that you would like to share with us, Karen, that we haven't discussed today related to the economy, the market? I'm kind of curious to know if JP Morgan's position is that, assuming the Fed does lower rates and we continue on, obviously we can't account for some of these global events. Obviously, there's unrest in the Middle East. We've got the blockade there in the in the Red Sea, I think, or is it the Red Sea, the Persian Gulf, wherever it is. Those things we can't account for. We don't know what's going to happen. We just don't know. But if everything just kind of continues on the way that it seems to be tracking, does JP Morgan believe that we are on the cusp of our next great market and economic expansion?
Yeah, that's a great question. I think the short answer is yes, we're always on kind of the cusp because of how innovative companies, particularly here in America, are. I tell this story, and this might be a good way to end it. So I graduated from college in 2000, and my senior project was to build a website. And I said, this is the dumbest thing that I could ever spend time on. Who's going to use a website ever in their life? And I can't explain how the internet works to you, but I know that 99% of what I do on a daily basis is driven by the internet. There is a lot of optimism at JP Morgan that the future of what you're hearing from things like artificial intelligence and how that could apply to productivity from companies that have a hard time finding these available workers and creating productivity. The players will probably change around, and the ultimate winners will probably change around. But ultimately, this is going to have the same impact, if not greater, on the future of productivity here in the United States as the internet did. Now, we're early on in those phases. And, like I mentioned, it's not going to be a slam dunk. I graduated and headed immediately into the tech boom and bust, right? So things like that can happen, but ultimately companies will figure out how to take advantage of new technology and use it to increase shareholder value. So we're extremely optimistic that, while we might be sitting at all-time market highs, that the market is just going to continue to move higher and to the right over time. So yeah, short answer is yes.
Okay, good to know. Lisa, any parting words from you today?
Oh, well, along the AI side of things, I've heard that I read this morning, there's talks of adding a metadata like watermark to your AI produced images, so that we could potentially, I don't know, as a consumer, be able to tell if it was actually AI produced or if it was an actual original. That would be my question. But that's just more research on the AI side of things. But I'm excited to see how it changes our industry, and it might disrupt a few industries, and those that do pivot and continue to learn are the ones that do survive, or it's the next best thing, like the iPhone or something else. So I'm excited to see what comes out of it.
Oh, I love playing around with the stuff. I asked a couple of days ago, ChatGPT to give me a market update in the tone of Deion Sanders. And it was awesome. Like it was the best in the spirit of football. Like it was amazing. So just that kind of stuff, like, I don't know. I think the creativity that's going to abound from that type of stuff is pretty awesome. But again, you'll have bad actors as you always do, and you'll have lots of things that don't go well. But ultimately, is it going to be a benefit for stock prices and, figuring out how to tell what's real and what's not real? I think there's a lot of industries that can be spawned off of just what's happening with large language models. So lots of exciting things to come.
I agree. I agree. Meg, you're the newest
Go
member of
market.
you do what now?
Go market.
That's right. For our clients that have not yet met Meg, Meg again is in our client services area, our client onboarding specialist. So when you come into the office, you'll get a chance to meet her, and she'll be handling a lot of your needs and questions, that sort of thing. And she's got a wealth of experience in this industry. She's worked for companies like Payne Weber, Morgan Stanley, Wachovia. There's always one I forget.
UBS.
Yeah, UBS. She's also been a licensed advisor herself in the past, so she's got a lot of experience, a wealth of knowledge in this industry. We're very pleased and honored that we were able to find Meg. Lisa as a certified financial planner and is certainly part of the future of ChappelWood Financial. We want to thank all of you for being on today. Karen, thank you so much for being our special guest. We really appreciate you taking time out of your day to join us and to share with us your insights and JP Morgan's insights. And I want to also thank all of our wonderful clients. You guys make what we do a joy. You're the reason we do what we do. And thank you. Thank you for the faith and the trust that you show in us. I was paid probably one of the best compliments I've ever been paid as an advisor yesterday by our client, Liz. Terry, I know you're listening. Terry was in the room whenever he heard her say this. She said that frequently she'll come into her meetings with us with anxiety. She's watched the news. She's seen social media, all this stuff, and she's just feeling kind of meh. But once she finishes with our meetings and we talk and we use sound reasoning and logic, she always feels better when she leaves these meetings. And that's what we want. We want you to feel better. We know there's a lot of bad news out there, and we know sometimes it gets scary and it's hard to tune out all that noise. When that happens, give us a call, come sit down with us. It's not always roses. We're not just going to blow smoke up your skirt, as Victoria would say, but there's always reason for optimism. Things are not always as bad as they may seem when you watch the news. So stop watching so much news. Stop consuming so much social media. Do stuff that makes you feel good and be around people that are going to make you feel good instead of feel lousy. And that's one way that you can feel better about the world. And believe it or not, it'll help you make better money decisions when you do that. So thank you so much. We'll see you next time for our next market update. Call us if you have a question. And if you're not yet a member of the ChappelWood family and you'd like to learn more, give us a call, 405-348-0909, or text us, and we'd be happy to chat with you. Thanks so much, everybody. We'll see you next time. Bye-bye.